Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we consider a different topic from the world of investment and look to the lessons as laid down by the father of the craft, Benjamin Graham, to shed light on the matter at hand. In this episode, we'll be looking at two opposing philosophies when it comes to investor outlook. That is the efficient markets hypothesis and the parable of Mr. Market. We'll firstly define what we mean by each and then go on to look at what evidence is available to presuppose one or the other philosophy may or may not be true. For they cannot, by definition, both be so. One group or the other must be seriously barking up the wrong tree here. So without further ado, let's get right down to it. As ever, sit back, strap in and get ready to absorb another lesson in value investment as inspired by the man himself, Benjamin Graham. Now here's the thing, regardless of what type of investor you are, be that a value investor, a growth investor, a speculator or some other subgenre, you need to take a definite stand on one particular matter. There's no option to sit on the fence on this one. It is not available a la carte. That matter is whether you believe in the efficient markets hypothesis or not. There's no middle ground. Let's first take a step back from that declaration and consider exactly what we mean when we talk about the efficient markets hypothesis. This, in a nutshell, is the proposition that the huge amount of people buying and selling shares collectively do a great job in assessing all the information out there and arriving at an accurate valuation of what price a stock should be selling at. The idea is that whilst some people might have got things a little wrong, there is a large enough amount of people and brain power to collectively arrive at the correct conclusion. On the face of it at least, this is not a completely ludicrous proposition. Millions of brains independently and rationally crunching the numbers and digesting the facts should be able to do a much better job than any single brain in isolation. But I'm sure many of you will have straight away noticed the problems in that last sentence. The words independently and rationally. The fact that the efficient markets hypothesis, in order for it to work, relies first on the independent actions of the great body of investors is an obvious problem. The fact that something like 3/4 of all equities are owned by institutions is a fly in the ointment here. So straight away, we don't have millions of independent investors making judgments on the vast majority of the decisions. We instead have a handful of fund managers deciding on what prices should be paid. These fund managers, whilst I'm sure are better qualified than the guy on the street at this particular job, their decisions whether to buy or sell will not be solely based upon whether a stock should be bought or sold. That might sound like a strange statement, but it's certainly true. Many other factors unrelated to the attractiveness of a stock will also come into play here, such as the need to sell to meet redemption requests or to balance a fund portfolio for some other reason. But the overall point is that 3/4 of the equity market will be priced up and valued by just a handful of people who, even if we were to assume they were any good at it at all, are not necessarily buying or selling on the merit of a business alone. So this leaves the efficient markets hypothesis at the mercy of the 25% of the equity holders controlled by millions of non-institutional investors. So the guys and girls on the Reddit forums then. Of course I'm being harsh here, because amongst that bunch there were people like you out there who do know what they're doing, but you get my point. The sad fact is that most individual investors who sit in this ownership group will not be very good at selecting stocks. Most will be herd-seeking and looking towards others for direction. The problem being that everyone ends up looking to everyone else. And this is why if you see a field of cattle, they always have an electric fence around their field, as they do have a propensity to wander into the road. But herds of investors are not bound in by electric fences, and the outcome is often a bloody disaster. Even investors in this group who do think independently and do actually know what they're doing when it comes to pricing a stock are not guaranteed to improve the batting average in this category, for paying the right price for a stock will only be half the battle. Many will simply not be temperamentally suited to have the confidence of their convictions when the brown stuff hits the fan. In times of market turmoil, all that hard work will likely fly out the window and they will sell out at exactly the wrong time. So where does this leave the hypothesis exactly? Well, strangely, it leaves it relying on a handful of people who do know how to independently and accurately price a business and do have the necessary emotional framework to hand. You guessed it, the validity of the hypothesis relies upon the value investor. The very same people who think the theory is a load of crap to start with. The value investor has a much better understanding of how things work in reality in the form of Benjamin Graham's parable of Mr. Market. The allegory points out the dangers of groupthink and herd mentality through the actions of Mr. Market. Graham asked his readers to imagine being one of two owners of a business. The partner in this business was a very obliging sort of chap, as every day he would offer to buy or sell his stake in the business at a price that corresponded with the mood he happened to be in that day. Some days he would be in a fabulously optimistic frame of mind about the prospects of the business and would offer to purchase his partner's shares at an absurdly high level. And on others he would be convinced the business was worth less than the bricks and mortar alone, in which case he offered to sell his stake at a very low price. His partner was of course free to decline Mr. Market's offer, safe in the knowledge that he would come back with a completely different offer the next day, but could take advantage if the price was right. Mr. Market, like the great body of investors that make up the market as a whole, displayed all the classic depressive traits. He was interchangeably moody, euphoric, emotional and often irrational. But the value investor is not here to show sympathy for Mr. Market's unfortunate condition. We're here to take advantage of him. We should not confuse him as a guide. He is there simply to serve us and offer us the chance to buy low and sell high. What Mr. Market also highlights is that occasionally, often more through luck than good judgment, is that the markets as a whole will be efficient. But occasional efficiency is not what the hypothesis subscribes or promises. You cannot base a hypothesis on something that is only fleetingly true. This also leaves out the very important point that even if the markets were to be generally efficient, it is never going to be wholly efficient inasmuch as some businesses will be priced rationally and others will not. So even if the efficient markets theory was true in a general sense, there will always be plenty of individual businesses that are priced too high or too low. I think that leaves us in no doubt about who I believe is barking up the wrong tree here, and on which side of the fence I sit. To summarise, you need either to place your full trust in individual investors, on average knowing how to value a business and having the right behavioural qualities to back up that know-how, and have faith that institutional investors who make up most of the market and who presumably have a superior knowledge, basing their decisions to buy or sell purely on the facts of the matter and not on unrelated matters. This is a ludicrous proposition in my view. A much better idea is to place your bets on Graham's parable of Mr. Market, an emotional creature with little handle on the vagaries of business. With him on the case, the price of the markets are likely to be efficient as much as they are under or overpriced. I think I know who you're going to place your money on. That is all for today's podcast. I do hope you've enjoyed it, and the comparison between the efficient markets hypothesis and the parable of Mr. Market leaves you in little doubt that due to the unpredictable actions of the market as a whole, it is never going to be truly efficient. Park your lot with Mr. Market and take him up on his offers when he's having one of his meltdowns. Do consider adding to playlist if you think it's been worthwhile, and do join us again to discuss another topic on value investment. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.